All right, let's talk about what happens when a company makes an acquisition. Its balance sheet changes, of course, but two line items in particular, goodwill and non-controlling interests, are often, let's say, deeply misunderstood. So today, we're going to move way beyond the textbook definitions to uncover the strategic stories they tell us about ambition, value creation, and power.
And that brings us to the core question, right? Is a balance sheet just a boring record of the past, or is it a forward-looking document? For our purposes, we're going to treat it like a map, one that reveals management's deepest expectations and, really, the economic DNA of a deal.
So here's our game plan. We'll start by looking beyond the raw numbers on the balance sheet. Then we'll deconstruct Goodwill and NCI one by one. After that, we'll see how they come together in a deal, what economic signals they send out, and finally, how a really sharp analyst uses all this to gain a serious edge. Okay, let's dive right in. The goal here is to shift our perspective away from pure procedural accounting and towards real economic intuition. Here's what you really need to get. These are not passive accounting entries, not at all. They are active signals. Goodwill tells us about a company's ambition, what it's willing to pay for future potential. NCI, on the other hand, shines a light on the ownership structure and the, frankly, complex power dynamics inside a consolidated corporate group. So now let's really dig into Goodwill. We need to stop thinking of it as a simple accounting plug and start seeing it for what it truly is, a strategic asset. So, this is the standard definition you'd find in any textbook. And you know what? It's procedurally correct, sure, but it's just the leftover number after a mathematical exercise. It offers almost zero economic insight. Exactly. That definition describes an outcome, a result. It doesn't tell you anything about the motivation. It tells us what goodwill is arithmetically, but not why it exists economically. And that is the critical distinction we have to make. So what is it really? Well, goodwill is the price paid for everything that can't be formally recorded on the balance sheet. Think of it as the present value of all those future benefits, like expected synergies, where 1 + 1 = 3. It's the price for untapped growth options, for a strategic position in the market. At its core, it's a quantifiable bet on generating future excess returns. This really captures the essence of it. When a company pays for goodwill, it is literally paying a premium for its own strategic vision. It's a very public declaration of the value that management believes it can unlock way beyond the target's tangible assets. Okay, let's flip to the other side of the consolidation coin, non-controlling interests, or NCI. Now, this is crucial. NCI is not a liability. It is an ownership claim. To put it simply, NCI represents the equity stake held by minority shareholders in a subsidiary that a parent company controls but doesn't own 100% of. And let's be crystal clear, this is a real, legitimate equity claim on that subsidiary's assets and earnings. So think about it this way. If a parent owns 80% of a subsidiary, that other 20% doesn't just vanish into thin air. Nope, it's held by other owners, and they have a proportional claim on that subsidiary's net assets and, importantly, its performance. And this is where it gets really interesting. These two ownership groups have different and often competing incentives. The parent company? It's focused on group-wide synergies, big picture strategic goals. The NCI holders? They care about the subsidiary's specific cash flows and its local performance. This tension has very real governance implications.
All right, so now let's put the two pieces together. Because the way a company chooses to account for goodwill, especially when NCI is in the picture, reveals its entire economic view of the acquisition.
An acquirer has a choice here, partial goodwill or full goodwill. And this choice isn't just some procedural box-ticking exercise. No way. It is a profound economic statement. Partial goodwill recognizes only the parent's share of that future potential. Full goodwill recognizes 100% of it, implying that the value creation is going to benefit everyone, including those minority owners. So if a company uses the partial method, what are they really telling us? They're signaling that they believe the synergies from the deal are proprietary. They think that value is going to be captured primarily by the parent, and it's not expected to flow down to the NCI holders. It's a very specific claim about who gets the profits. Full goodwill, on the other hand, is a much more holistic statement. Here, management is signaling that their actions will enhance the value of the entire subsidiary, lifting the fortunes of both the parent and the minority NCI shareholders. It's a much broader, more inclusive view of value creation. Okay, so how do we, as analysts, actually use all this? How do we read these economic signals in practice, out in the wild? Well, the first thing we have to recognize is that a big goodwill balance has a direct, and I mean direct, analytical consequence. It increases the invested capital denominator in your performance metrics, which creates a higher bar for management. They have to generate truly superior returns just to justify the premium they pay. You can see the mechanics right here. For any given level of net operating profit after tax, your NOPAT, a larger base of invested capital, which is inflated by goodwill, is going to structurally lower your return on invested capital. It's just math, and this forces us to scrutinize the quality of those returns even more closely. And that brings us to impairment. A goodwill impairment charge isn't just some non-cash accounting event to be ignored. It is a formal, public admission that the economic premise of the deal has failed. The expected excess returns that justified that goodwill in the first place, they never showed up. All right, let's bring it all home. What's the ultimate takeaway here for valuation and analysis? What is the edge? Your edge as an analyst comes from this deeper intuition. It's about seeing past the procedural accounting and understanding what these numbers are really saying about strategy, about expectations, about incentives. This is how you assess whether management is actually creating value or destroying it. So I'll leave you with this question to think about. The next time you're analyzing a company and you see a goodwill impairment, ask yourself, are you just witnessing a simple accounting adjustment, or are you looking at the ghost of a failed strategy? The answer to that question is what separates a good analyst from a great one.